Contrast that with bearish outlooks from two of the biggest players located on opposite sides of the country. Goldman Sachs in New York says stay away from equities for the next 3 months. But don't look for safety in treasuries because Double Line's Jeff Gundlach, who's big in bonds, says there's no upside in U.S. debt. He's got more than $100 billion in assets under management. So let's bring in a guy. I've known this guy forever. He's the CEO of Cantor Fitzgerald, Shawn Matthews. Your firm has about 5,000 institutional clients globally. When you hear that Gundlach is saying that and then Goldman is also fearful, you say what to our investor viewers?
Well, look, I agree with Jeff that I think there is limited upside in the U.S. Treasury market. Certainly, when we look at 10 years at 150, could they go a little bit higher? Sure. But in reality, you would be a net seller whenever you thought that the market was going to turn. And I think when Goldman is talking about this, they're really talking about a short-term technical trade as to, don't be long the market for 3 months. When you look at expectation, it's now about expectation management. So as we look out over the next 5 years, we have to look at what the return on equities is going to be. And I think it's going to be mid-single digits kind of returns. And in the fixed income market, you're going to have lower returns than that. We just are in a low inflation, low interest rate environment.
Okay, knowing, though, as we look at, say, for example, the NASDAQ, where a lot of these stocks like Amazon are doing incredibly well, knowing that the herd can charge ahead, and you don't want to fight that in many ways, shapes, or forms, but knowing that it can quickly switch, tell me what's a decent trade right now from where you stand, where you can capitalize on the upside, but then make sure that you don't get trampled when the herd shifts and goes down?
Yeah, I think from the perspective of technology stocks, I think people are looking at them saying, we're going to be in a lower interest rate environment for an extended period of time, right. So I'm going to pay for growth, right? And I think that's a trade that's going to continue on. I would actually shy away from those stocks at some point here in the relatively short term and actually look for deep discounted areas. I think the banking sector provides an interesting opportunity right now. We know we're going to be in a low interest rate environment. The banks still have reasonable earnings power. Their balance sheets are in really good position. So I think when we're looking at longer term plays, I would certainly look to that sector for opportunities.
Just those big money center banks like Goldman and Morgan Stanley, or also maybe the regional banks, because those look like affordable plays?
I would actually look more towards the commercial banks, right, the J.P. Morgans, et cetera. And even the regional banks make a lot of sense as well. So really, in looking at it, you want to go to the traditional banking sector where there is opportunity to make money. Balance sheets are in good shape. And NIM has come down, but that's okay because we're in a low interest rate environment.
Shawn, I look at this and I say, wow, it's an interesting time, isn't it? Does anything make you stay up awake at night? Does anything concern you beyond a crying baby? I don't even know if you have one, but market can be a crying baby.
Well, yes, exactly. Lack of volume is certainly something that we've all lived with for an extended period of time here. And I think that's going to continue on for a short while because we're in a low interest rate environment and people are actually trying to just buy and hold as much as they can. And that's the new world we live in.